The Federal Reserve has already communicated that they're going to taper starting November. And that should last about a year into the second half of next year. What are the consequences of tapering into a probability of a lower growth environment, or with is the Fed, and on the other side is the question prevails itself, is the Fed ignoring its unemployment mandate? Because you're tapering and looking to raise rates and take liquidity off the table in a time where there's low labor force participation and high unemployment.
Yeah, well, I think the issue with the Fed, and that's a key question to ask, Abdullah, is the problem with the Fed right now is they're in a sense trapped, and they're trapped from different angles. But one angle that they're trapped from is, they have this dual mandate, and they are trying to make sure that they keep inflation and inflation expectations anchored. And as this transitory narrative starts to dissipate, and it is dissipating. I mean, if you look at the Fed minutes or Jay Powell's press conferences, the references to transitive inflation have basically, well, they've been transitive and they've completely just gone unmentioned. So
Right.
actually in the last of Powell's conference, I don't think he even mentioned transitive. And Bullard comes out and he's saying, look, we're looking at inflation for longer. So the Fed's trapped. It's easy for the Fed over the last decade to have continuously eased and cut rates and done QE and buttressed markets because there was always this disinflationary pressure. So no matter what happened, the Fed could say, hey, look, disinflation, we're going to QE or cut rates or whatever it is they did. No longer the case right now. And so I think what you're seeing currently is actually, it's not just the Fed that's trapped, it's a lot of global central banks that are trapped, and they're being trapped by this odd occurrence, which you can see here on the bottom right-hand chart on page 35, which is you have commodity prices on the left and the broad dollar on the right, and that broad dollar is inverted. And so look at this divergence that you're seeing right now, which is commodity prices are going through the roof. At the same time, we see dollar strength. And so, that might be a tough situation for the Fed, but it's far more difficult for global central banks who are essentially being forced to tighten and slow their economy just to help bolster their currency, because if they get currency weakness, it actually exacerbates the inflationary pressure that they see. And not and when you think about commodity producers, whether you're an OPEC producer or you're a country like Australia that produces metals, you don't produce everything. So the rising energy costs may be great for Saudi in some respects, but it's less great if you have food prices going up, if you have copper or steel or aluminum prices going up, because they're importing a lot of those prices. Similarly, it's a problem for Australia because although you may have copper prices rising, or Brazil where you have copper prices rising, well, you also have energy costs increasing as well. And so you're actually seeing this net effect where it's tough and you're facing the rising dollar at the same time. And so I think that's why you're seeing a lot of central banks look to increase rates. And it's crazy, right? Because you look at a place like the UK where their growth outlook is significantly worse than it was pre-COVID, and also because of the Brexit situation that's going on there. And they're losing a lot of high quality jobs, and there's four rate hikes priced in. I think there's four rate hikes priced in there. There's four rate hikes priced in Canada. Like, it's insane that these central banks, you're seeing rate hikes being priced in amid a much weaker or just less certain economic outlook. So I think that's one issue that's at play here. Now, with respect to the Fed in particular,